In this video, we're going to be looking at how to analyze a property investment deal. So in reality, when we're looking at a deal, it's always good to start with the end goal. So what is our aim and what are we aiming to achieve? An example could be like of a general end goal is that we're looking to build a portfolio of buy-to-let properties to give us retirement income. So we're looking to put money into property, grow a portfolio, a set of properties, so that when we want to retire, stop working, we've got passive income coming in. That's a general goal. But then when we're looking at a deal, we need to become more specific. So let's say, getting more specific, we're looking for a BRR deal, so buy, renovate, refinance, rent out and repeat. So there we're looking to put money in to buy a property, and we're looking to get most of that money out when we finished buying, renovating and ready to rent. And so let's get really specific. Let's say we're looking for an end valuation of £140,000. So that's an end valuation that we can use as a basis for refinance. So to get most of our initial money out. Then let's say we're looking at achieving a net monthly rental income of £1,200, and with the plan of operating this house as let's say a mini HMO. And a third specific end goal is, let's say, to get 80% of our initial money out. So we're going to set these goals, we're going to write them down, and we're going to analyze our deal objectively, not emotionally, objectively based on this end goal. So that is our end goal specifically for this property. But we also must, I think must is the important word, looking at alternative exit strategies. So if something goes wrong or we don't achieve, let's say, maybe the valuation that we're looking to get, we're not able for some reason to rent out as an HMO, what are our alternative exit strategies? What can we do to get out of the situation? And here, for example, there were two possibilities that we need to analyze, look at the figures to see what happens if we have to use these exit strategies. One could be, instead of refinancing, we're going to sell. So we need to understand at what price we can sell. How much of our money are we going to get? At least a bit more of our money than we put in. And then we were speaking about end strategy of operating as an HMO. If that doesn't work, we need to consider alternative exit, which is renting out as a standard buy-to-let. Won't be as much income, but we need to analyze and see, is it still going to be like a satisfactory outcome if we've got an issue operating as an HMO. So we've set our end goal, we've been specific on the end goal. Then whilst analysing the deal, the next question that we must ask ourselves, are these end goals realistic? Because it's very easy to set end goals, and are these end goals realistic, of course, for a specific property that we're looking to purchase. So let's say we've got our end valuation goal of 140,000. To determine if that's realistic, we're not going to be looking at for sale prices, which could be well above like the real market prices. We're going to be looking at sold comparables in the same area for the same type of house, and we're going to realistically say what end valuation can we get based on those. And we're going to analyze if we've set an end valuation of 140 and it looks like we can only realistically achieve 120, then let's not stretch it, and we're going to say this is not the deal to go for. So we're going to, and also like rental, in our end goal we put, for example, on this one I'd written 1,200 net monthly income as an HMO. We're going to analyse that. We're going to look at what are the average income per room in the area. We're going to look at our costs of our council tax, utilities, management costs, etc. And we're going to understand if that is realistic. And then if we've got our two alternative exit strategies, we've got the possibility of selling. So that should be fairly easy because the selling price should be similar to the end realistic valuation. And then if we're looking to rent as a standard buy-to-let, we're going to look at comparables and objectively determine for our alternative exit strategy, renting as a buy-to-let, is that going to work out? Is that going to give us the income that we are looking for? And is that going to be cash flow positive? Then we like sort of starting from the end and working backwards. Now we're going to like sort of start at the beginning and the two are going to meet. So we do need to start with like a purchase price at which we think we're going to potentially buy it, or at least put an offer in. We're going to calculate all our costs. So all our costs is obviously there's the purchase price, stamp duty, legal costs, finance costs if we've got them. Probably if we're talking about, well, not probably, if we're talking about a BRR project, then we've got refurbishment. And to all these costs, we need to add a contingency. Typically, if we're talking about renovation, refurbishment, we're going to add 15% contingency on that. So when we've got all these figures, we're going to use, well, most likely an Excel template. For people that follow our training, we've got detailed templates that can be used to analyse deals. So we're going to put all the figures in, and we're going to see how everything works out, and we're going to determine based on our purchase price all the costs. We get looking at the end potential refinance. When we're looking at the refinance, we're going to be assuming that we can refinance at 75% of the end value, and then at the end of all these calculations, we've got the information about how much money we're likely to be able to get out. We've got the information about our expected income and cash flow. Cash flow is the total rental income minus the mortgage payments and minus the different costs. So when we've looked at all this, if we see that at the purchase price that we've set, the offer price, it's not a deal, then we'll work backwards. We'll reduce the offer price until this meets our criteria. Don't try and change things like end value. Think, oh, we can get a better end value, or we can manage to squeeze the renovation costs. Both of those are, especially the end value. Maybe if you've got time and you're looking to be more involved, do some of the renovation work yourself, you can maybe squeeze a bit those costs. Maybe if everything else is good, you might be able to do that, but don't have false hopes or expectations on the end valuation. Be really realistic on that, and then work everything backwards. See what the purchase price is for it to be a good deal. Even if that purchase price is a lot lower than the asking price, don't be afraid to put an offer in. And that, obviously, if everything else works out, don't be afraid to put an offer in at that price. Maybe it's going to be rejected, but keep that in mind, and maybe a month or 2 months later, phone again the owner or the agent and say, look, I see, well, the house looks as if it's still for sale. Would you reconsider the offer that I made earlier? So yeah, how to analyse a deal, be objective, start from the end, look at all the figures, use templates, and yeah, one other thing to take into account when analysing a deal, it's risk analysis. So take a fresh piece of paper, write down all the things that could potentially go wrong. Things like renovation is more expensive because we find some hidden things that need repairing. Renovation takes a lot longer than we expected. If you're doing a project that's got planning takes longer to get than we expect. And then consider like maybe some economic changes between start and the end value, we don't get quite what we were expecting to get. Consider the impact of those risks. Is it going to cause the project to fail? And if that is potentially the case, then don't go ahead. So I think that, that's a general overview about how to analyse a deal. We've got more detailed training which goes into details of the different strategies. And we've also we can actually help you. We've got a service for helping analyse deals, which is also part of the mentorship packages that we offer.